Good morning, everyone, and welcome to our webinar on IPM performance for the month of March. Thank you so much for joining us on a Monday morning. So today what we will be covering is, besides looking at the IPM performance, we have decided to present or do analysis on a topic of interest. But before we go to that, the IPM for the month of March has shown a very robust growth of around 9.5%, which is quite encouraging, and majority of the therapies and a good number of companies have shown this type of value growth. The unit growth remains a challenge. We will delve further on the growth aspects as we go to the IPM performance piece. To start with, what we have decided today is we are working on analysis of strategic partnerships in the Indian pharma industry, because somewhere partnerships seems to be a buzzword. So we thought about delving a little deeper into this aspect and touching on some key areas where partnerships are happening. Followed by that, we will be looking at the IPM therapy performance for the month, the growth drivers, the top 40 corporates and brands, and the key takeaways. So we go to strategic partnerships in the Indian pharma industry. What we will be discussing is the introduction piece, the need for partnerships in the Indian pharma industry. We'll be looking at certain core case studies, the challenges that companies face when it comes to partnerships, and the way forward for the Indian pharma industry as far as the partnerships is concerned. The reason why we took up this topic is day in, day out, we keep on reading a lot about partnerships happening in different areas, whether it is portfolio acquisition or divestments or certain synergies in the operational excellence piece. We see a lot of partnerships happening. This indicates that a lot of interest has arisen in the Indian pharma market for this. So we thought about doing some studies and checking out the finer aspects of the partnerships in Indian pharma industry. Before even going to the Indian pharma industry, we thought about looking at a top level. We're looking at a top level, just a minute, of why partnerships are important and what needs to be done. So overall, the market dynamics across the industries has become one of the compelling reasons to foster partnerships. For example, if I were to look at technology-driven opportunities, there is a rapid change in the technology which leads to increased obsolescence. For example, in earlier days, a manufacturing date or manufacturing batch number would have sufficed to give authenticity of the product and also prevent unnecessary movement of the products across different areas. However, that has become obsolete, and today the barcoding system has come into picture. Probably over a period of time, even the barcoding system becomes obsolete and a newer technology would be required. However, what is important is this newer technology is accompanied with a price benefit. So it's not that you come with a newer technology and it becomes expensive. So being the best is no longer an option. You need to be the best at an economical price. Also, the COVID times have shown change in customer preferences, change in customer priorities. Earlier, buying things, probably 50% used to happen online, 50% used to happen through brick and mortar stores. But then in COVID times, we have got used to the ease of getting things online, delivery happening to your home. And we have also seen that in certain cases, we get a lot of discounts when things are purchased online. So the customer priorities of purchase, of selection of goods has changed. So have the marketing strategies or the digital marketing campaigns need to be adjusted in that particular way. The third aspect is the asset management. Lean assets decrease fixed capital cost, thereby generating positive impact on the bottom line. This is very important because as you grow, there is a lot of duplication of manpower, infrastructure, technology that happens. So a good partnership with a partner having the required strengths definitely helps in managing our assets better. Last but not the least, or the third last is the operational efficiency piece, where as the companies change in their portfolio or they expand in their portfolio across products or services, there is an increased investment that is needed as far as the resources are concerned, as far as the R&D is concerned, and this creates a lot of pressure on investment. A good partnership helps you to manage that. The talent pool, enhancement of technology and introduction of new products and services demands a lot of upgradation in talents. Now, this talent is not just in R&D or the back-end piece, but then you also require a good amount of talent pool in the sales team, the marketing team, the distribution infrastructure, even your partners such as distributors, retailers, etc. So this talent pool, if you have a partner readily available who can help you, it really helps. And last but not the least is the shareholder value, because your shareholders are definitely interested in your pace of growth, how fast you can grow, and how delicately you are able to manage your top line as well as bottom line. So all of this essentially creates the need for efficient partnership in the overall market, not just the Indian pharma market. So to summarize this slide, partnerships increase your lease of knowledge, expertise, and resources available to make better products and reach a greater audience. Now we come to the pharma industry. While the last decade has seen openness of pharma industry to partnerships, COVID has further accelerated its pace. Now, if I were to talk about certain archetypes in the pharmaceutical industry, I would broadly categorize Indian pharma players into three aspects, or pharma players into three categories. First is the originators, second the generics, and third is the consumer health companies. The originators are the ones who focus a lot in R&D. They are the ones who focus on getting newer molecules or newer dosage forms or newer treatment protocols to manage the unmet needs of a disease portfolio. So these companies focus a lot on R&D. Lot of investment is gone in R&D, and hence these companies are majorly bottom line focused and believe in having products at a premium at a premium price for a particular segment of disease profile. Next is the generics, which excel in producing and delivering drugs at a lower cost and as a result are fully backward integrated. They may not invest a lot in R&D, but they are more in, they may have a better expertise in scaling up. And third is the consumer health, wherein which these set of companies, they promote drugs directly to patients using mass consumer marketing techniques. So probably these companies, they focus more on the products that can have a different sales channel, probably a sort of FMCG sales channel where reaching to lower town classes or reaching to a wider customer base becomes very important. So net, all of these companies, whether it is originators, whether it is generics or consumer health, all of them have their own strengths. So an integrated model to combine synergies to tap the market potential becomes very important today for the Indian healthcare industry. Why? Because the critical size requirements in each market segment expands much faster than the company's capabilities to grow. Probably earlier, focusing only on the top 20, 30 mega metros made sense. But today, even smaller towns like Vishakhapatnam in south or a Satara in west, today even these towns are growing very fast. They are on the verge of becoming mega metros. So you really cannot afford to neglect these cities. Management of subcritical business and expansion in new businesses. What do I mean by subcritical businesses? The businesses in which the companies are already present. For example, as cardio-diabetes segment becomes an attractive segment or attractive portfolio to have, many companies do have their legacy brands in the gastro segment, the anti-infective segment, or certain acute segments. So managing a fine balance between the acute and chronic portfolio, which the company is trying to have in order to expand in the Indian pharma market, it becomes very important. Then efficient capital allocation across R&D and manufacturing. This is important because in a particular category, you need to continuously innovate in terms of the different molecules, the combinations that come into picture, or the novelty that you need to continuously bring in the dosage form, the delivery form to maintain the excitement for the customer or the consumer to keep on coming to you again and again. Pharma business, again, is a remarkably stable business with not many major events destabilizing it. Reason, it's a healthcare industry. So the prevalence, incidence of diseases more or less remains the same. As far as the growth is concerned, if the population is growing on an average of 1% year on year, even the incidence and prevalence of diseases, the percentage would remain the same, but the population growth would also more or less remain in that same category. So the market, the disease is supposed to grow in that same rate over a period of time. The only aspects which destabilized the Indian pharma industry in COVID times were the distribution aspect, because all of a sudden everybody was caught off guard and distribution was an issue. Availability was an issue for some period of time, but it was not that the disease patterns got changed significantly. So in a stable industry, which probably everybody can predict will grow at a particular rate, if I'm able to have certain good partnerships, why not have those partnerships and make the most of the market potential? So what we try to look at the common partnership models in Indian pharma industry, there are mergers, acquisitions, divestments, co-marketing aspects, operational tie-ups, in-licensing and joint ventures. In this 30 minutes time, we may not be in a position to cover all of them, but we will focus on the first three pieces in a crisp way. So mergers and acquisitions and divestitures are some of the most prominent styles of partnerships we have observed in the Indian pharma industry. So even before going in details, let us look at what is the academic definition of mergers. So mergers and acquisition, a combination, what we talk about merger is a combination of two or more companies into a single company, whereby the assets and liabilities of one are vested in other, with the effect that the former enterprise loses its identity. Whereas in acquisition, it is slightly different. It is an act of acquiring effective control by one company over the assets or management of other company without any combination of companies. The two companies can exist as independent entities and enjoy separate legal entities, but there may be change of control of the companies in terms of control on particular product portfolio or particular divisions or sales and marketing teams, distribution teams, etc. The second aspect is the divestitures, where, or commonly it is known as divestment. It is known as defined as a complete or partial disposal of an asset. There are multiple ways in which this happens. It depends upon the preference of the company's executives, whether it is done through sale or closure or bankruptcy declaration. So why do we look at mergers and acquisitions? One is to optimize the economies of scale, eliminate duplicated functions, share managerial expertise, or synergies, taxation, market power because of decreased competition and diversification. So if I were to talk about some mega mergers or mega acquisitions that happened in the market, a little old example, but then quite relevant, is acquisition of Ranbaxy by Sun Pharma, a huge giant acquired by Sun Pharma. Though it had its own set of problems when it was at Daiichi, but then still by acquiring these products or products from Ranbaxy, Sun Pharma could actually make its position stronger in the Indian pharma market, because Ranbaxy was also among the top 10 corporates in the Indian pharma industry. Similarly, if I were to look at Torrent acquired a part of Elder, Unichem. So they actually got exposure to a significant brands, set of brands like Shelcal from Elder, which gave it a strong position in the gynac segment, the ortho segment, or Unienzyme, which has got from Unichem, which has got a sort of OTC footprint. So the advantage that both these companies had is they could acquire a good number of strong brands which had a significant name in the market and also were there in the pen habit of majority of the core prescribers. As far as the divestments is concerned, the reasons why divestitures may happen is focus on intrinsic capabilities in therapeutic segments, build high margin business for higher returns, or improvement in the bottom line, clearance of debts, or many a times the investors are interested in intelligent divestments if they want to see the company's focus. Here I would take an example of a established MNC in India. Novartis has been in India for quite some time. Still 15-20 years back, I would say Voveran was one of the major brand of Novartis, and it had a strong focus in the acute segment. Of course, Glivec was also there for the onco business, but Novartis was more known for its Voveran in the acute segment. It launched Galvus a few years back, and through Galvus, it started making its position stronger in the chronic segment. Over a period of time, we have seen Novartis divesting Voveran to DRL and Galvus to Cipla. So what happens is, while the brands are strong and established brands, the priorities of the company have changed. Now the company wants to focus more into its specialty or super specialty business in the oncology on the transplant segment. So giving away these brands to companies who can still manage these portfolios better made a lot of sense, because these brands have got a strong name in the market, as well as the companies who have taken these brands like DRL or Cipla. They have got a name in the name in the industry. They have got a stronger manpower, a stronger distribution chain, who and thus can guarantee that these brands are only going to grow in the market. Some of the examples, some of the recent examples that we have, I have just taken two case studies. One would be for acquisitions and other would be for divestitures, which have happened in the recent past. Over here again, I have not taken all possible acquisitions or divestitures that the companies may have done. I have taken only a few examples. So if I were to look at acquisition by Eris Pharma, 51% acquisition in Swiss Parenterals. It is a leading player in the injectables business with presence in over 80 emerging markets. It has got its strong manufacturing facilities, and this acquisition has strengthened Eris's footprint in the injectables business, both at a local as well as global level. Then it has taken the branded formulation business of Biocon Biologics. It has strengthened its position again in the injectable segment. It has made its position stronger in the insulin segment, or it will become stronger in the insulin segment. And had also opened doors of Eris in the oncology and the critical care segment. Dermatology brands from companies like Oaknet, DRL, and Curatio. What it has done is it has best products in the derma segment, manpower and specialty breach brought under Eris's umbrella through these acquisitions, enabling Eris to create a formidable position in the derma segment. The second case we have is divestitures, wherein we have Sanofi as an example, because many of these have happened in the recent last 2 to 3 years, or something which has happened in the last 1 or 2 months. So look at the nutritionals portfolio. The nutritional portfolio of Sanofi was given to Universal NutriScience. 16 leading nutraceutical brands, including some of the leading brands like C-Cod, E-Cod, CoQ, Primosa, Colaflex, they are transferred along with all the employees associated with this brand, especially the sales and marketing team. Again, if I were to talk about soframycin going to NQ Bethicals, so key derma brands like soframycin, Sofradex, they were sold to NQ Bethicals, and NQ is a leading manufacturer of prescription and OTC skincare products globally. And they will take their first step in strengthening their position in the Indian market through these labeled products. Also, the recent example wherein there is an exclusive distribution and promotion agreement with MCure for their cardio brand. Now, over here, the arrangement is such that Sanofi will continue to manufacture and import these brands and retain its ownership, whereas Encure will leverage its reach to expand access to these medications for patients across India. In fact, Sanofi India's employees working in these brands would also be offered an opportunity to join Emcure. So basically, what Emcure has done is they have given the products to companies or to the companies which they feel that will be in a position to nurture these brands well and also ensure the growth of these brands and manage the employees as well. Now, if I were to look at when I'm talking about drivers of these partnerships, so synergies are focused on optimizing in areas of sales, marketing, manufacturing, R&D, and operations. So from a marketeer's perspective, it's mainly for market entry, portfolio expansion, focus on core portfolio, optimizing manufacturing facilities, and focus on core competency, whether it is R&D, marketing, or channel sales. So net-net, while partnerships look very great and rosy, there are also good number of challenges which many of the companies face. If the objectives of partnerships are not well thought of, there has been a drain of resources which has ultimately impacted on the bottom line of the organizations. If I were to look at mergers and acquisitions and the challenges, new corporate culture and identity can create a lot of uncertainty and anxiety, especially for the companies which are getting acquired. So there may be a lot of attrition that may also be seen. Mergers and acquisitions that are done with an objective to reduce competition may lead to monopolistic scenarios, which may again not be correct for the Indian market. Many a times, mistakes lead to drain on the company's profitability for several years post-acquisition. Because once you acquire a division, once you acquire a brand, you're supposed to keep on growing it. And if the acquisition goes wrong, it is a drain on your resources because you need to keep on investing on the entire thing till you see success. So giving away the everything easily and very fast becomes difficult. As far as the divestitures are concerned, divesting itself is a challenge because many a times the companies are focused on the growth and size of the company. When you divest, you actually shrink the size of the company. There is an emotional attachment because there are many people who are there in the company for a very long period of time, even at a senior level within the organization. There is an emotional connect with the brand or the portfolio that has got developed. And giving away this portfolio becomes a little, uh, it becomes a little difficult for the people who have built it. Talent transfer, because as we see, the talent has to move from one company to another. There is a cultural difference between the two companies, and we really don't know how the new company is going to adjust or how the people are going to adjust to the new company. Many a time there is a mindset change. So if I were to look at the chief marketing officer, he would be more interested in the top line of the company, whereas the finance officer would be more interested in the bottom line of the company. So having this delicate balance also becomes a challenge for many of the companies. So if I were to look at the key rational points to remember in strategic alliances, any type of partnership has to be well thought of, keeping the long-term objective in mind. Timeliness is very important because once you decide this is what we will be doing, then execution becomes the key because there are key milestones to be achieved. There is a revenue milestone which has to be achieved year on year. And if timeliness is not there, then we actually lose the market opportunity for which precisely this partnership was built. If for any reason the outcome is not achieved, then dragging on with the plan really doesn't make any sense as it drains the resources. So if I were to look at the way forward, challenges and opportunities have geared the pharma industry to make the most of the partnerships wave, and there may be many more unique partnerships evolving soon. Indian pharma industry has been and will be witnessing some very interesting partnerships. While the overall industry is bound to show highly optimistic performance, race to reach the top slot is intense. Indian pharma companies are gradually mastering the art of mergers and acquisitions and divestitures to ensure a strong top line, that is value generation, and bottom line, that is profitability. So these are a few examples that we could take in today's time slot. Of course, every month we'll be coming out with our IPM diaries, and in IPM diaries for this month, we will be covering all these topics in detail along with exciting case studies, which would definitely be a good read for the entire industry. If you have any suggestions in any of these areas, kindly feel free to reach out to me and give your examples, which we will definitely include it in the IPM diaries and give you credit for the same. Now, our next section, we move to the IPM therapy performance for the month. So overall, if I were to look at for the month, the growth of the Indian pharma industry has been quite encouraging. It's close to 9.5%. Cardiac, anti-diabetes, derma, neuro, anti-neoplastics, ophthalm, urology, and vaccines. These are the segments which have shown a good double-digit value growth. While unit growth overall seems to be a little stagnated, these therapy areas which have shown a double-digit value growth have also shown a very encouraging unit growth as well. If I were to look at the growth drivers, price seems to be the strongest growth driver for the Indian pharma industry, followed by the new introductions. And even these new introductions, we have seen them primarily more in the anti-diabetes segment and the blood-related segment, where there has been either a patent loss of good number of molecules which were from the innovator companies or certain areas where exclusivity rights in the elemental iron section have been lost and many new introductions have come in the market. Coming to the top 40 corporates, while most of the corporates have shown a double-digit value growth, Alchem is one company which have shown a double-digit growth in terms of value as well as units. Among the next 20 companies, we see companies like Cadilla, Corona, Forts, and Natco, which have shown a double-digit growth in terms of value as well as unit. Coming to the top 40 brands, While GSK and USV continue to stay in their number one position, unit growth seems to be a challenge for both, whereas Augmentin continues to show a good double-digit value growth. Rosuva's, Monosef, Thyronorm, and Pan among the top 20 brands continue to show a double-digit value as well as unit growth. Coming to the next 20 brands, Pantop, Asilog, Telma, T-Bact, Ribelsis, and Brilenta continue to show a very good double-digit value as well as unit growth. To summarize about the performance of the Indian pharma industry, the industry has shown a robust value growth of around 9.5%, with majority of the therapies showing a positive value growth, except the respiratory. Price growth have continued to be positive, whereas volume growth is negligible for the month of March. For the month of March, majority of the top players have shown an encouraging value growth, and Augmentin and Glycomed GP continue to retain their leadership position in the market even for this month. Thank you so much for joining us for today's session, and any feedback, suggestions are welcome. Kindly connect with me on these contact details if you have any feedback or suggestions. Have a nice week ahead.